Welcome to the Trader's Desk. It's the 29th June 2025. Before we get started, this is not financial advice. This is purely for educational basis. Do read the disclaimer and also read the copyright notice. So, looking at the Magnificent Seven, a large part of the rally seems to have been driven by capital inflows back into the top seven stocks. Um, I think, with the exception of Tesla, a lot of these companies are doing great, except from Tesla and Apple. So, um, Tesla is still struggling a little bit, even if they come out with spectacular news about the future. I think the market has kind of realized that there's a lot of fluff, and a lot of what's being painted for the future is probably to hide all the weaknesses that are currently underpinning the business. But, Tesla is not something I trade actively, so, it doesn't really matter what my views are on this. But what's important for us to understand always is when we see a stock market rally, we need to understand what's been driving that rally, right? Which are the leaders? Where is capital going? And from that perspective, we also need to understand whether there is a strong fundamental basis for that rally. Um, Moving on, let's look at the RSP. Sure, we've had another rally on the week, but it's not been as significant as we've seen for the Magnificent Seven. So I think later on in the presentation, we'll see where we discuss a little bit around the topic of, are we going to see this rally being predominantly driven by the Magnificent Seven, or just tech and Magnificent Seven? Or is there like a possibility that this rally broadens out to, the other companies within the S&P 500? Because if we are able to figure this out, there's, significant returns that we can make, right? And meanwhile, everyone else is just latching onto headlines as in, yeah, S&P 500 touched this level, the market is just about to crash, and all of this, these extremist narratives that lie very far from the truth, right? At the end of the day, headlines are there for sensationalism. They are there to sell newspapers, to get clicks, to get you to click on a YouTube video or on a news article. They're not there to help you figure out what's going to happen in the financial markets next and how you can make money on top of that, right? Quite a notable move in the US 10-year yield. So we've been watching this for a number of months now, and it's quite interesting to see this finally breaching the 200-day moving average. So we are lying somewhere around 4.28% in terms of the 10-year yield, and it's looking like this has room to go a lot lower. Also, what's been creating this downwards pressure has been a couple of things. So the CPI reports have come out relatively benign in the last few months. So a lot of the scare around inflation has not necessarily yet materialized. Uh, of course, a lot of the trade deals have been pushed by 90 days or whatever, right? So I think the new deadline is 8th of July, if I remember correctly, 8th or 9th of July. Um, so we definitely are gonna see a lot of news around this, which could create upside or downwards shocks. Um, we've got a few trade deals that have been announced, and then a few others that have been lined up, sorry, um, as being the next ones to be announced or to be signed. It's all a show at the end of the day, right? The details matter a lot. So what Trump has really done here is he came in and then he just threw like a bunker busting bomb on the markets, driving expectations really low. And then, he comes back and he says, okay, 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 I'm gonna give you like a bone to chew on. And then everyone really likes that, because if you think about it, right, let's say he's agreed 55% import tariffs with China, which he says he has, and he says the deal is signed, but then there's been like proper silence from both ends when it comes to the details. So let's just assume he got elected and then he says, okay, we're going to negotiate a 55% import tariff deal with China, and we just got it signed. That would have been perceived as a big negative event for the market, right? But what he did is he just killed all the expectations right at the start by announcing like crazy tariff numbers that look like trade embargoes. And then he came back with a little bit of a sweetener and, giving people confidence that it's just not going to be as bad as they initially assumed. And, markets have this nature of always climbing the wall of worry and chewing on, every type of bones that, politicians or CEOs give them to chew on. And here we are making new highs, right? Um, I think we have to be very careful here because over the next few weeks, there could be a lot of event risk, which we will discuss later. And this could change the picture or could bring in more volatility in the financial markets. And if anything, you could have even higher highs in the S&P 500. That's, nothing is to be ruled out. Um, a lot of times where especially people who don't understand how financial markets work, where they struggle is they have this view that, the market has gone up a lot and it has to come down, or, that the economy is weakening. So it means that the market has to come down. And every day as the market is grinding up, they just cannot understand what's going on because that's in total contrast to what their belief are, right? Um, and then they just get paralyzed because they think that the market is about to fall like any time because they have this strong belief. Where does that belief come from? I don't know. Maybe they've read an article from Ray Dalio, and supposedly Ray Dalio is the biggest, best investor or whatever, has X number of years of experience doing whatever in the market. And now, because Ray Dalio has said this, they think that the market has to behave in that particular manner, and this is where people just get crushed. And what happens is the self-confidence just gets trampled on as if an elephant has just walked on your self-confidence. So you either feel defeated by the market or you feel angry that the market is doing something that you could not anticipate or foresee doing. And then it either manifests in one of two ways. One is you give up and you're like, okay, everything's rigged. This makes no sense. I'm just going to sit it out for 3 months, 6 months until the market starts doing what I want it to do, which will never happen. And then the other one is, you feel angry about the whole situation and then you start shorting the market at all-time highs and do a little bit of what I call revenge trading. So, at the end of the day, you have to realize the market gives zero uh, care about what you think, how you feel. The market doesn't know you. The market doesn't know what you're doing, doesn't know what you're feeling or thinking. The market is a beast on its own, right? And as you're interacting with it, you just have to realize this. This is, the market is not there to make you money. The market is not there to placate your feelings and to make you feel good or intelligent or, whatever you want to feel for yourself. The market is certainly not there for validation. And the quicker we understand this, the easier the whole journey will be, and the clearer, everything will be visible to us. If we stick to retail trader like crappy mentality where they form like a small group and you know there's a lot of group thinking, they read all these experts or they listen to a YouTube video from an expert and they think that this is what the market is going to do, will always be losing. And this is definitely not something you should do, right? At the end of the day, there are many stocks, hundreds of stocks moving 10, 15, 20%. There are hundreds of stocks moving 10, 15, 20% down, right? Up and down. And our job is basically to find them before the move happens, position, and then, just ride the whole thing. Our job is not to develop feelings around positions, the markets, financial markets, or, whatever's related to that. And that happens when we are making money. And that also happens when we're not making money or even losing money in the financial markets. So, irrespective of where you're at, right? It's very important to just be totally emotionally detached from this beast, because that's something that's very important to understand, especially for retail traders. A lot of times there's way too much emotions, way too much like psychological crap going on in their heads, and that prevents them from being very good traders. And from, I mean, a lot of people, they don't struggle with trade idea generation. They struggle with, being able to convince themselves that this is the right trade to put in their portfolio. Um, the vast majority of people have a very good sense of how to do analysis, right? This is not the limitation. The limitation is on the psychological front, where they've done the analysis, they know it's based on imperfect information. There's a lot of question marks. Um, the difference between the average and the winners is that the winners are able to exercise judgment, take risk, and still put the position in the portfolio, irrespective of, knowing that this is based on imperfect information. We cannot predict the future for sure, and all of this, right? People who manage money, of course, know this, but they still believe that they have a higher than, let's say, 50, 60, 65% probability of being right, and they're willing to play the game on that basis. So this is a little bit of psychological talk that, we also need to have as traders, especially as, if you're working for a hedge fund or investment bank, it's not your money, right? It's just a job. You don't even care about what the outcome of this whole thing would be. When it's your own money, and the difference here is, if you're sitting at a hedge fund, you're sitting amongst your peers, you see like 10, 15, 20 of them, you congregate, you have lunch together, you have a community to talk to, right? As a retail trader with a full-time job, you're in your room, and whatever little free time you've got, you're investing in that in terms of your analysis and forming a view on the market and so on. And sometimes you would still be wrong, right? And this is where the struggle begins, because you feel like the market is out there to get you. But it's not like that. The market doesn't know you. It doesn't know that you're long, short, all your views are X, Y, or Z, right? So this is something that's very, very important to understand, because, as we were coming out of this deep selling route, I had a lot of people writing to me saying, I just don't understand how the market is rallying. And I'm like, look at the chart. Is it rallying? Yes. So, right, the truth is that it's rallying, and it's going to make a new high tomorrow and next week. And next month will probably be at all-time highs. So whether you understand it or not, whether it's like making logical sense to you or not, doesn't matter. Where is it going to be trading in a month's time? And what should you do on that basis is the real question, right? Not how do you feel about this, right? Um, if you introduce feelings in this whole game, you will get sorely disappointed. Okay, so enough of psychological feelings or emotional talk. But it's a very important component, because I think especially amongst younger people, right? They've been fed this message that, you if you don't feel it, a lot of things around feelings, and it's completely bullshit, right? Because feelings change. Feelings can change anytime, right? You wake up on Monday feeling very happy, then by lunchtime you're sad about something else. Feelings just keep changing, right? It's feelings are not necessarily based on anything rational or anything true, right? Um, and if you lead your life based on how you feel at that point in time, uh, it's going to be a very difficult life. I can tell you that. Um, a lot of people, they will not do something until they feel it or they feel right about something. That's not how the world works. The world doesn't know how you're feeling or what you're feeling. The world doesn't really care about your feelings, right? Actually, you should also not care a lot about, all these erratic feelings that you get every second. These are just distractions of the mind, right? Um, and if you really sit down and investigate why you feel a certain way about a certain situation, you will just realize that at the end of the day, this is just a form of comfort or escapism from the truth. If you feel, very sad about a situation or you feel angry about the situation, it's just a way to kind of shut off and get in your corner and not deal with a situation. Um, at the end of the day, think about it. The people who've achieved great things in the world, if they said, no, I'm not feeling it today, you would not have aeroplanes, you would not have rockets, you would not have so much development within the medical field. Think about it, right? Like surgeons, sometimes they are getting calls like in the middle of the night and they had to like wake up from their sleep, drive to a hospital, do like an emergency surgery. What if the guy just said, look, just not feeling it, right? It's not gonna work, right? If these people who are really like at the top of, uh, you know, if you have to think about people who perform really, really well, day in, day out, you would tend to find yourself gravitating around athletes, I would definitely put surgeons and doctors, paramedics. These are the people who cannot afford to have an off day, right? Um, think about a paramedic, right? He's like, yeah, maybe he has some personal issues, then he gets called onto an accident scene. He's not going to be like, no, I'm not going to do a CPR because I just broke up with my girlfriend or something happened in my personal life. That's really not how it works. So the lesson to learn here is if you want to get top performance, if you want to be a top performer, there is a certain level of emotional discipline that you need to work on and also practice. So that's something that I think as traders, the earlier you understand this and the earlier you accept it, the better you'll be trading and the easier your journey will be. Because, a lot of times the pain is just psychological. It's like the market not agreeing with you. How can this stock be down 5% when I'm long it? That's literally the problem for a lot of people. Anyway, let's move on. So, I think I've mentioned this in the Discord server. A large part of this rally has also been driven by the momentum stocks. So, if you want to know what momentum stocks mean, you can look at the MTUM ETF and just look at the holdings. You typically see a lot of like non-profitable tech stocks and all these names in there. The highly retail driven names. So have a look at them because you never know, you might find good short ideas within, good short trades. So definitely something to look into. There's another index, I'm not sure what it's called, but it's something along the lines of, I think it was put up by Goldman Sachs, like non-profitable tech stocks or something like this. So what we've seen is every time the market has bounced back, these are the stocks that outperform everything. And that's predominantly because of short covering. So a lot of people are being forced to to buy back their shorts. And of course, as they buy back their shorts, the share prices go up. Then you've got other people who just come in and pile up and, drive these share prices much higher. Just because something has traded 20% up on Friday at $200 doesn't mean that on the next Friday it will be trading at $250, right? What we really need to understand is that 20% rally that happened, was it on the basis of fundamental improvements, or was it just because of a technical factor like a short squeeze? Because if it's a short squeeze, and we've done our work, we've realized that actually earnings are coming, the company is still struggling fundamentally, the short interest has come back down. uh, it might be a great entry point as a short, right? So now you get to short that company at $200 instead of like 170 or 180. And then the company eventually goes back down to 150, 100, just because there are no fundamental buyers of the stock. And we've seen so many of these companies. A few of you who have been trading for a long time would definitely think of a few names here. Like C3.ai was exactly like this. It kept rallying. I think it went up to 45, 47. Uh, and then eventually there's no buyer, right? At earnings, it just sells off like crazy. And, when these things are happening, don't just be a spectator or bear witness to it. You have to be positioned and participate in these. Okay, moving on to sector performance. Believe it or not, only four sectors have outperformed the S&P 500. So these are communications, technology, consumer discretionary, financials. Um, I think a couple of weeks ago, I spoke about communications, right? And you would remember from the analysis of Lumentum Holdings, we also kind of diverged a little bit into the telecom providers and trying to understand when the reordering will happen there. So basically, the story was that inventory levels were relatively high, and that was driving down demand for a lot of these communications equipment providers. So companies that are involved in this space typically would have uh, their clients in one or two or even three segments. One would be the hyperscalers, the data centers, and then the telecom providers. So what we saw was that last year, maybe we're talking 6 to 8 months ago, or even 12 months now, the telecom providers were not ordering that much because they still had high inventory. And now what I think is starting to happen is that a lot of this inventory has now come back down to normal levels, and we might be at the cusp of the reordering that's happening within the communications equipment segment. So these would be things like routers and like a lot of networking equipment, 5G equipment, switching, a lot of like technical things like optical connectors and so on. So, if you are researching that area, I probably would just review that thesis and understand whether we can find a few ideas along these lines, because these are like the silent winners, right? No one talks about these guys. Everyone's talking about AI, Nvidia, but the real ones that are winning and rallying week in, week out are not the likes of Nvidia. Sure, it will have like a very good week and then move sideways or even sell off for a couple of weeks. And everyone is in that trade. So the moment there is any bad news about that company, it will just get sold off, right? The better way to play this is with a lot of the companies that are not discussed as much, but still essential companies that are producing and selling products that are essential for the whole AI infrastructure build out. So, a few names here. Maybe we can discuss it in the second segment, but a few names here would be the likes of Lumentum Holdings, Broadcom, uh, Sienna. I don't want to say Cisco, but maybe even Cisco. Um, but yeah, I mean, if you start peeling through the layers, you'll find easily you can find 8 to 10 names within the maybe the mid cap segment that are also involved within this chain. Um, Moving on, so it's not a surprise that tech has had another stellar week. So tech has been the strongest performer in this rally. Tech has been the driver of the rally. Um, a large part of this boils down to the impending Fed cuts, right? But at the same time, I think what we are also seeing is that uh, the GDP is slowing down in other parts of the economy, but growth levels are still relatively healthy within the tech space, largely denominated by AI and whatever's happening. So, capital is chasing a lot of that growth. We've seen the valuations within the tech space. Um, I would definitely not say that, these are like normalized valuations, but they are high for a very good reason, right? Sure, maybe not every company can justify its own valuation, but at a sector level, I think we can justify it. And at the same time, I think there's a lot of front running that's happening with this whole interest rate cut. So, what might happen is um, because everyone's already positioned long in that space, when we get the rate cut, it barely creates a rally in that space because everyone's already positioned for it. There was another thing I wanted to share, but it's not in this presentation. But what I'm also thinking might happen is if you look within the tech space, you'll see that you probably can classify these stocks amongst three categories. One is the high performers. So these guys have, relatively high PEs, relatively high growth levels. And I think these guys um, would not necessarily react to a rate cut because it's already priced in. However, where we might see you know multiples or valuation multiples move up a bit more would probably between the mid and low tier tech stocks. So that's probably how we need to be thinking about it because it's almost like for the top tier companies, investors are like, we don't really care what's going to happen on the rate cut front. This company is outperforming; it's going to keep outperforming. Um, we want to buy it. We're not going to ask any questions. But when it comes to the lower tiers, that's where capital is a lot more discretionary, and it really wants to justify the valuations and so on. And as you get a big macro tailwind in a Fed rate cut, I think that could set off the stage for a lot of these, let's say, medium to low tier companies to have their multiples re-rate upwards. Um, we can share a lot more on that in the Discord server. It's still like a theme that I've been thinking about, but certainly worth discussing it at a stock level. Um, Quite interestingly, we're seeing consumer discretionary get back into saddle. So if you have been following, the consumer sentiment reports have kind of bottomed. The Michigan University of Michigan report has ticked up from a low, and all signs point to the worst being behind us. So the lows were made when the whole debacle around trade deals and everything was happening, and now it looks like consumers are lowering their estimates of future inflation and feeling better about the whole economy, right? So I think in this situation we might be seeing a bit of upside risk in that consumers feel that it's not all doom and gloom, and we see these sentiment surveys just tick up, right? The other one, which I don't follow that actively, the US Conference Board, it's I think this was it this week or last week. It ticked down. So a bit of conflicting information between these two sentiment reports, but I think eventually what will happen is people will just feel better about the whole situation, and then we'll see, a lot of short covering between in the consumer discretionary sector, and also a lot of capital just pouring back into the sector. So definitely an area for you to start hunting for longs. Um, then moving back down, just one second, I've got a question here. What is an upside risk here? The risk of getting caught on shorts when the sentiment? Yeah, definitely. It's not just the risk of getting caught short, it's also the risk of not being overweight consumer discretionary. So let's say you've got a portfolio that's positioned a bit defensively, and then consumer discretionary stocks are just flying through the roof, right? You will have to rotate and get back into consumer discretionary. So it's not always just being short. You might have a higher exposure to staples or maybe healthcare and some of the defensive sectors. And then you realize you were just wrong on that view, and that the US consumer is still very healthy and happy to spend, right? So that in itself will cause a lot of capital to rotate out of defensives and move back into these cyclicals, particularly consumer discretionary. Like, uh, let's take an example, right? A company like BC, Brunswick Corporation. So they manufacture boats, and we know the narrative has been that demand has been down, debt has been a big issue for the company, debt mainly in terms of their floor plan expenses, right? So if interest rates start coming down, right, is that enough to kind of give the company a little bit of extra cash flow and for it to start re-rating upwards? It's currently trading around 52. So, and I'm not suggesting you should go long the company, but that's how you need to be thinking about it, right? If we get, let's say, a 25% basis points cut, and then we get a couple more in the rest of the year, let's say we get two, right? If we get a bit of relief from that, by how much will the interest expenses of the company be reduced? And at the same time, would this also create more demand for boats, right? So you can see how this could create an inflection point for the business, right? Because if it's trading at 52, it means that everyone's kind of given up on this company. And now it's time for the long-term investors to look at it and look out into the future, like maybe 12, 24 months later. And if they can see that this company could go back to 80, 90, 100, they're definitely going to start buying. Remember, right? Like at the lows, people are not looking at the next earnings, right? It might still move by 5, 10% on the next earnings, but unless it's like a bankruptcy situation or something dire, people start looking out a lot further out. Yeah. Um,
Thanks for sure.
yeah. Okay. No worries. Let's move on. Industrials had quite an interesting week, right? But still did not manage to outperform the S&P 500. I think industrials and materials are two sectors that I would start looking a little bit more closely. I think there are good long opportunities within. We'll discuss this in the second part of the presentation. And then for the remaining sectors, we still have healthcare that's underperforming. I think it's been the victim of a lot of regulatory risk, but I think there are still good long opportunities here, especially, as the market is making an all-time high. And maybe if you think it looks a little bit vulnerable here, and you could have a bit of capital rotation into defensives, it might be a good idea to start digging into healthcare sector. And then finally, energy and real estate, relatively, bad performance on the week. If you haven't rallied in a week like we've had, that's a bit of a red sign. But of course, energy, we know exactly why it's not rallied. That's tied up to the oil price, which in itself is, a result of, the whole long positioning that happened during the war, and now people are just caught on the wrong side and they're reversing their positions. So um, I think it doesn't make sense that the US economy would be doing really well in terms of growing and economic activity, and then the oil price will come down, right? These two, do not really work. You cannot have these two happen at the same time, especially if we believe that the US markets are very strong and they're going to be like, you know, um, we're going to have multiple more years of this, bull market. So one of them have to give. And the problem here is if you take the crude oil price and you adjust it for inflation, it's uh, it's going to be much lower than the $65 that it's currently trading at. So essentially, I think it all comes back to global oil demand. Uh, but if the US is doing well, I think the rest of the world will eventually catch up. And even with China, India, and so on, they'll probably come back up and, drive the oil demand further. Um, I think the time to be long oil is not, when you've got like a geopolitical situation. It's before that. And if you think about it, if we have more hostilities with Iran, which is not to be ruled out, right? The oil price could easily go up, like, a lot more than where it is at the moment. So that's another way to think about it, right? How do you protect yourself against, waking up on a Monday and then realizing that Iran has just blown something else in Israel or vice versa? Um, you would never know ahead of time that this is going to happen, but you have to be protected in one way or the other. Okay, let's move on. In terms of industry performance, a strong comeback by semiconductors. So this segment has been up 14% on a monthly basis, right? Quite incredible. I think Hans would remember probably 3 to 4 weeks ago, we had a call and we were looking at a company called Astera Labs, right?
Yes, I remember it.
And then so I told him, look, you're looking to buy a company that's within the semiconductor segment. And at that time, the semiconductors were not performing that well. So it looked like, it could sell off from there. Um, and this is something that's quite interesting, which I think we should look into. So let's quickly look at this, right? So Astera Lab, right? So semiconductors had the best performance, in the month. And then look at what Astera Labs does, right? It's almost flat or even down on the month. So we could even plot SMH against it. Right. Let's maybe look at the last month. So the semiconductor segment is up 15%. Astera Labs is down 6%, right? And Astera Labs was, if you look at the daily chart, and this is something that you guys have to be looking out for, as you're sometimes chart gazing, right? So On Tuesday, it kind of bounced off this 200-day moving average. Then, you know, you've got more hopeful participants that come in. Then it has like a big rally. I think this was like a 10% rally, maybe, yeah, 8, 9, 10%, right? And then on Friday, it just gave all of it back and even more, but eventually closed like flat, right? So, this is a stock that's finding it very difficult to break out, right? You can clearly see that. And it's finding it very difficult to break out at a time where the semiconductor segment is probably having like a massive bull rally, right? So if you look on a 3 months basis, so semiconductors are up 27%, Astera Labs are up 39%. What does this tell me? I think what this tells me is that Astera Lab is already, like a lot of the growth is already well priced in. And it's going to be very difficult for it to make new highs from here, right? At least that's what the market is, or at least that's what my interpretation of price action is suggesting. Um, would you go short Astera Labs? Probably not. But would you go short Astera Labs if you're long light or something within that segment? Then it becomes a bit more of an interesting discussion, right? On its own basis, at this point in time, I probably would not go short Astera Labs. But if I have a short, you know, predisposition on AI or semiconductors, then I probably would pick this company as my potential short, right? And you could also plot light against the same thing. So this is Lumentum Holdings. On a 3 month basis. So Lumentum Holdings is up 48%, Astera Labs up 39%, the semiconductor segment is up 27%, right? So this is how you need to look at price action. And then if we go back to the discussion that I had with Hans, I think you were probably looking to get long somewhere here, right? And you can see, right? Maybe you would have made money because you probably would have sold somewhere here. But if you, like 4 weeks later, right, if you had done nothing, you're still flat. It's basically just time decay, and especially time decay in a stock that has high implied volatility. So would this have been the best trade 4 weeks ago? I'd probably say no. Of course, we don't know when we're here, right? Or maybe we were here. I don't remember exactly. But these are the signs we have to keep looking out for to figure out whether we have a good chance of being right or not. How does that work? If you short a company, are you, yeah, what, how do you, if you're short a company, are you not betting the price will fall? How do your other holdings impact? Um, what I'm suggesting here, Haider, is um, if you're long a company like Lumentum Holdings, you're long the whole semiconductor space, you're long, AI and all of that theme. Um, Sometimes you want to have a hedge against that long position, and this is where you would go short a company like Astera Labs, maybe. The whole idea is that in the next month, let's say there are no bad news around AI. So Lumentum Holdings goes up another 20%, but then Astera Labs maybe goes up 5% or is flat, or even goes down. So essentially you make the difference between the two. Um, but the ideal situation would be where, let's say, there's terrible news that comes maybe from China, where they've gotten even better at efficiency in their models and so on, that hits the whole AI segment. So Lumentum Holdings might be down 20%. But Astera Lab will be down 50% or 40%. And this is the hedge that I'm talking about, right? When it when the risk doesn't play out, you still make money on your long. When the risk plays out, then you lose money on your longs, but then you make a lot more on your shorts. So that's a way to kind of protect you against sector or industry risk. It's something we can discuss a bit more, but just in the interest of time, I'm just going to go back to the presentation. Um, so Solar had another good week. It's quite interesting that Solar manages to keep up despite all the headwinds around regulations being or regulations that were greatly in favor of solar now being pulled back in terms of incentives and so on. So that's an area that probably warrants a bit more in-depth looking. There's a company there that maybe I'll discuss in the second part of the presentation. Um, what was interesting to me was the regional banks and home builders. So regional banks are having a bit of a comeback. I think a lot of it is due to the economy performing well, but also this whole talk of deregulation. So we don't yet have a timeline or even an idea of what it's going to look like. But what we can kind of gather from the first Trump season is that we probably will see more red tape being removed. And that would lead us to believe that we'll have higher lending activities, maybe even reduction in the capital requirements of a lot of these banks. So if you think about it, if banks are able to reduce their capital requirements, it just means that they have more lending capacity, or they could just release that capital, give it back to shareholders. There are various ways they could play it, but typically what would happen is they would just leverage up and um, reduce capital requirements, take out more loans, and on that basis, it would drive a lot more activity in the economy as well. So unless we have a delinquency crisis, I think this segment is prime for a lot of good months. In terms of the underperformers, not surprising to see oil services and oil and gas at the bottom. This is one that Bhavan would like a lot. Gold miners. I think was it last week or the week before that we suggested that this is probably a good pain trade. Uh, it's actually working. So we have all this talk about Fed rate cuts, and then gold is still selling off. So part of me believes it's because of the geopolitical situation having been relieved a bit. But still, right, you would have thought that gold would actually go a lot higher if the Fed starts cutting. But essentially, what's happened is people have already been positioned for that from many, many months. And this is why the gold price is like 3,000 plus, right? So now we're seeing a bit of a pullback within the gold miners. I don't think it's the end. I think it's only started. So if you want to play this idea, find a company where the costs are a little bit out of control. But because it's been a good environment, investors haven't really been paying a lot of attention, right? They've kind of dismissed the increasing cost. Typically, with gold miners, the problem you'll have is uh, so it's an extractive industry. Their deposits are always shrinking because they're chipping from that and producing the gold, right? So the value of the company is a combination of the cash flows, but also the future deposits, right? So the company has to keep digging, finding new deposits or buying other smaller miners to be able to keep its deposit level healthy, right? So as the deposits are extracted, what happens is you typically will start with the high quality deposits, the ones that require probably lower cost to be able to extract. or the ones that give you the best, let's call it return on cost, right? And then as that deposit gets depleted, you have to go to the lower quality deposits that are much more expensive to extract, and that starts showing up in your financials as well. Um, if you do your homework, I'm sure you'll find a couple of these companies that people have been dismissing this whole topic because the gold price was just going up. So it doesn't really matter, right? If your costs are going up by 10%, but the gold price is like up another 5% in a week, right? So in that environment, you would not really care about the situation at that company. So you have a situation where you have a lot of lazy longs. They haven't done their homework and now they're going to get found out, especially if the gold price just stays flat or if it starts falling. A lot of people will get found out. So the perfect pain trade. Um, but yeah, do your homework. I'm not going to give you, the all the names that you have to look into. Um, you can also start off by saying to yourself, look, let the market do my homework, right? You start looking at GDX. Actually, we could do that. Even if I promised I wouldn't spoon feed, but let's just look at this, right? Because if you know how to read what the markets are trying to tell you, you'd be able to shortcut your way to success so quickly. So I'm looking at the GDX here. Uh, let's go into the holdings, right? So the highest holding is Newmount. It's one of the biggest, and then you've got Barrick, Endeavour Silver, and all of these, right? So in the last month, right, even within the GDX, you've got stocks that have gone up 30%, and then you've got stocks that have gone down 18%, right? If you're looking for a short, right, you would not. I mean, you could look at this, right? You could still look at this, but typically, what I would do is I would find companies within this space, right? The ones that have not necessarily rallied, they haven't participated in the rally in the last few weeks. And that would be my sign of understanding that the market has done their homework and they've realized that these are not your outperformers, right? Um, and I would typically want something that's a bit of a large cap. So, as a short, this is where I want to be. Like, especially in gold mining, I don't want to go short a mid cap or small cap because it can very easily get acquired. These larger companies are always on the lookout for new deposits. So even if they are not the best of companies, they can still get acquired. So let's look at this guy, right? GFI. It's trading at a forward PE of 7.4. Um, Actually, what we could do, let me see if we can put this in a, yeah, we could do this, right? So a lot of you use Koifin, and I just want to show you how uh, you can be a bit more efficient with your process and find your answers a lot quicker, right? So this is the PE for the next 12 months. So if I just rank this by highest to lowest, right? Um, uh, Basically, what you'll see is the mid caps would tend to have higher PEs because they have a higher growth potential. And then as you look at the bigger deposits or the bigger companies, they would tend to have lower PEs because the growth potential is not that high. If you look at WPM, it's trading at 37 times PE. Just looking at this, I would probably think that this is a company that has great fundamentals because the market is willing to pay a premium for that. So I'm not going to go short this company. Um, and if you look at this, you probably would say on average, the sector, I'm not going to calculate it now, but you probably would say the average PE is around, let's say, 13, 15, right? So essentially, what you're looking for is, okay, let's pick this guy, right? Kinross Gold. It's like 18 billion trading at 12 times PE. Or you could even go back here, like Barrick, 35 billion trading at 10 times PE. Um, or even this guy, Anglo Gold, 22 billion trading at almost 11 times. So you pick a few of these candidates and then you start doing your research, right? And then from there onwards, you try to figure out whether there is potential for these companies to go further down. And typically, the angle I would take here is on the cost side. Is that making sense? Do we have any questions? Obviously, what I'm doing is very quick, right? But as you do it yourself, you would have to be a lot more meticulous. Any questions?
One here, Roshan. Could you recap on why we're looking at movements in gold? Are we just being defensive in light of the geopolitical side of things, or what's the driver behind our looking at gold in
Um,
particular over here?
so
Rally or,
the
or
hope
like
the whole premise is that the gold price is up a lot, right? If you
yeah, yeah,
if you look here, it's up a lot over the last year or two.
yeah,
Uh,
yeah.
what we're saying now is we probably have hit a point where the gold price will trade flat or even down. I mean,
Okay,
I don't
okay.
see the gold price going to 4,000, 6,000 in the next few months, right? So
Mm.
as the gold price is going up, a lot of people in the equity space are going to buy these gold companies, the gold miners, right? Thinking that this is a way to get exposure to the gold price. It's a leveraged way to get exposure to the gold price, right? However, they overstay their trade and they think that this is like the best trade on earth. It's going to go up indefinitely. And then what happens is you like from here, right? So from April, the gold price has not done much. If you think about it, it's been flat, right? And it's not to say that we haven't seen this before, but if we assume that this stays flat or even goes lower, then there is potential for a lot of these what I call lazy longs to realize that they are in the wrong situation, and at the same time, these guys have probably just got long the company without even doing a proper, thorough fundamental research. So the fundamentals start catching up with them and they realize they are in the wrong stock. So gold price trades flat. Uh, then these guys are like, oh, but should we still be long gold? And then they look at the company through which they've gotten exposure to the gold price and they realize, oh, costs are going higher, or the company is missing on earnings, or whatever other KPI that we normally look at. And then that creates the like a good environment for them to start becoming sellers of the stock. I mean, if you look at Barrick, right? The gold price has risen for like almost 2 years, but the stock is flat, right? If you look, it's been trading between 14 and 21, right? Uh, with the rally that we've had in the gold price, you'd expect this to be in the 50s or even close to 100, but it doesn't really get there, right? So the question is, are we probably hitting this point where we might move from 21 to, let's say, somewhere around 16, 15, uh, because that gives us enough room, right? Like if we go to 15 from 21, that's almost 30%, right? And we would put these types of trades in the portfolio as a pain trade, because as the selling starts, right, you would see everyone who's in the same situation starting to doubt their holdings and starting to you know reduce their weights as well. Give me 1 second. Cat's looking for my attention. 1 second. Sorry about that. So does that make sense, Haida?
Yeah, thank you.
Any other questions from the rest of us? So Bhavan, you see, when we called this out, you could have gotten short, let's say around $21, right? Maybe with a strike of, let's say, 20.5. And I think this could go even lower, maybe go to 19 or 18, right? And within this move, there's easily, let's say, 2 to 300% that you could make in a matter of weeks. And we've also got earnings coming up. So, when gold miners have earnings, that can be a bit of a shocker sometimes. So if we've done our work on the company and we know the story, we would definitely know whether we should be long or short. Okay, let me move back to this. I think the other thing I wanted to talk about was the retail space. So obviously, you know my view on the consumer discretionary space. Um, and I think that ties in well with the retail space. I think it might be the right time to start looking for some longs here. Um, you might do it through consumer discretionary. You might do it through companies within this ETF. It's up to you. But I think what's going to happen next is we'll see these companies attracting more capital. What I also must mention was that on Friday the consumer spending numbers were a little bit down, and it kind of disappointed from that perspective. But that's something to keep in mind. But I think just looking at how strong the US consumers have been, I'm not really seeing any reasons why we cannot have like a resurgence in these stocks. That, if you look at the XRT, it's probably like been battered. Um, so at an index level, right? We've kind of traded flat, and you see we've had a bit of a resurgence here. We're now trading just above the 200-day moving average. So I think this could easily go back to here and maybe even go a bit higher. And if this happens, right, the stocks within would probably have 30 to 40, 50% upside. And that's why I'm suggesting we probably need to start looking at this. Do we have any questions? Okay, none for now. Mm, I think that's about it in terms of what I wanted to discuss. Let's move on to the factor analysis. So on the week, believe it or not, mid-cap growth is still negative, relative to the S&P 500. So capital is still flocking towards large caps, and of course, capital loves growth, so that's where it's going. And the large cap value space is seeing a big outflow, not just on the week, on the month as well. Um, I think these things can change on a dime. I'm quite bullish on mid-cap growth, as you probably know. I'm also quite willing to start looking at good longs within the large cap value space. So, the way I think about these things is uh, I don't want to be like, I really need mid-cap growths to start attracting inflows and outperform the S&P to be right. So, I will not position my portfolio, in a way that if mid-cap growth doesn't pick up, then I'm just dead, right? I probably will have one idea for mid-cap growth, one idea from large cap value, one idea from, let's say, large cap growth or large cap, there's no call, but yeah, let's call it large cap growth. And that's, that's the way to kind of express that view. And also keep in mind, we're not trading weekly here, right? We're trading on a 4 to 8 weeks horizon. So there's enough room for everything to change and for mid-cap growth to start outperforming. And this ties in well with the thesis or the thinking that this rally that we've seen in the Magnificent Seven, which is being demonstrated by the large cap growth segment here, this rally broadens out and becomes a bit more. It happens a bit more within the mid cap and other segments. Okay. Lastly, the corporate bond spreads. So quite interesting that this was down on the week. Of course, that ties in very well with the risk on behavior that we've had. So the market doesn't really care much about risk at the moment. Sure, it's not at the lowest level, but it's also not signifying or signaling any danger here, right? But it's something to keep watching out for because these things can change on a headline, and there's a lot of event risk ahead of us. Okay, so let's start off the second portion of our presentation. This is only for Discord